Hello, accounting superstars. This is Professor Don Bush. I've been professor for about 30 years, CPA for about that long, and I've got great ways to explain accounting. You've come to the right place to learn accounting, folks. Hey, I've got a brand new website here called accountingsuperstars.com, and it's a place where you can find my videos, and they're all sorted out by topic. So that way, if you have a certain question or a certain aspect of accounting that you want to learn about, you'll have a lot better chance of finding it. So this is your very beginning accounting class, about fourth week, usually the fourth chapter in accounting class. And we'll do a closing entries, and closing entries are super simple. They are really easy. They're one of the easiest things, but students really mess them up. I've seen all kinds of crazy closing entries that are just no good at all. So you're going to learn how to do it. It's easy. There's nothing to it, folks. So here you go. We've got a company here, Social Media Partners. Now here's where we're at in this accounting cycle, is that we've done the financial statements. We've done all the transactions, all the posting. We've got the financial statements right here. We've got an income statement, and if we scroll down here, we've got a statement of changes in owner's equity, and we have a balance sheet. All right, and our balance sheet does balance. Here we go. Yeah. So total assets equals total liabilities and equities. So our balance sheet balances. So we're good to go. The boss is happy. So we print out the financial statements, and now we have to do our closing entries. So you might say, well, why do we do closing entries? What do they do? Well, the closing entries get the books set up and ready to go for the next month. So we're closing out the old books, getting it ready to start the new month. And it's super easy. And here's the thing you got to remember. Only close out income statement accounts. All right? Only close out income statement accounts. There's one little tiny exception here, and I'll explain the exception real quickly. But do not ever, 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 do not ever close out balance sheet accounts. Do not close out cash. Don't close out accounts. Don't close out anything on the balance sheet. If it's on the balance sheet, don't close it. All right, if you do that, you will definitely get it wrong. All right, and that's one thing that I see students do all the time. They like to close out everything or random things, so it doesn't work that way. Only close out things that you see on the income statement. That's it. So here's how it works. Revenue's got a credit balance. Okay, it's a credit balance, and I'll try to spell credit correctly here. Credit balance. There we go. So to close out revenue, we've got to debit it. You see, it's sitting there at $100 as a credit. And this is something you probably learned in like the second week of class. Revenue is a credit. But if you don't know that, now you do. Revenue has a credit balance. So to close it out, put it as a debit. So here we go. We'll put here $100 right there. In fact, it wouldn't hurt here just to write up above, say debit and credit. So that way you know what these columns mean. All right. There we are, debit and credit. Now, all these expenses here, like wages expense and rent expense and depreciation expense. Looks like I've got depreciation expense listed twice for some reason. So here we go. So all these expenses are sitting here as a debit. Every one of them, they're sitting here as debits. And that's something you probably learned in your first week or two of accounting class, that expenses are debits. And if you don't know that, it's good just to memorize it. Just memorize it. Expenses are debits. All right. Now, to close out these expenses, since they're sitting here as debits, we need to credit them. So all you do is take this $55 and list it here as a credit. And take this rent expense as $10 and transfer it over. Okay. So these are the closing entries. So you do that for depreciation expense. There we go. Now, our journal entry is not going to balance at this point in time. If you add up 55 and 10 and 5 and 5, you're going to get 75. It's not going to balance. Debits got to equal credits. So to make it balance, what we're going to do is we're going to use retained earnings or owner's equity. I'll make a note of this right here. Or owner's equity, okay? Either one. It depends on what kind of a business you have. If you have a corporation, it'll be retained earnings. If you have a sole proprietorship, it'll be owner's equity. So what you got to do is fill that in to whatever it's going to take to make it balance. And in this case here, it's going to be $25. So now, if you add up 55 and 10 and 5 and 5 and 25, you're going to get 100. So it balances right there. So let's review really quickly here. Only close out accounts that you find on the income statement. Are you going to close out accounts that are on the balance sheet down here? Does anything on the balance sheet get closed out? The answer is no. Never, ever. Don't do it. All right? Because if you do, you'll get it wrong. I mean, you'll just be wrong. Guaranteed to be wrong. Okay? Now, the one exception that I was telling you about is that we need to close out dividends. And dividends are not on the balance sheet, but they're right here in the statement of changes in owner's equity. And they're sitting here as a debit. All right? A debit. So to close out the dividends, we need to credit the dividends. Just do the opposite. So we'll have it $10 right here. Okay, 10. And I know it's listed as a negative 10 here, and I don't have it negative here, but it all works out. On the statement of changes in owner's equity, the account dividends has a debit balance. So here we go. So just credit it, and what we're going to use is retained earnings to make it all balance. And again, it'll be retained earnings if it's a corporation, or it'll be owner's equity if it's a sole proprietorship. So one or the other, all right? Won't be both, but it'll just be one or the other, depending on whether or not you're a corporation or an owner's equity. So there you go, folks. There are the closing entries. That's all there is to it. Very simple, very mechanical. That's all. In fact, that's all there ever is to it. It's just that easy. It really doesn't get any more complicated than that right there. So there you go. Hopefully you won't mess it up when you're doing your homework. All right. Hey, well, guys, check out the webpage, accountingsuperstars.com, for a listing of these videos. That way you can find videos by topic. And hit the like button and subscribe button. That way YouTube will show these videos, more videos for you guys. And until next time, over and out.